Welcome everyone to another episode of 144 and 360. Hopefully we can keep this under 6 minutes. This is where we go over how to use the Fibonacci retracements and following the 144 rules and guidelines. The quick update of just how we view the retracements are that any market that is extremely strong should hold 23%. The golden rule, 38.2%. That's the level that the market has to hold to keep the trend intact. 61.8 will usually send you 61.8 the other way, and 78.6 will send you 78.6 the other way, and can also be the end of and start of bull moves. We're moving out of the August meal and into the September, but we wanted to go over what had happened because just viewing the past can help you with the future here and how we view these things and what we look for, what our premium members got. And so we'll start here with the low that was made in October of last year. Now, as we just said, 38% should hold if this market's going to continue going down. Obviously, you can see it did not, telling you the trend is changing. Doesn't mean you just jump in. You got to be looking for other things to verify that as well. Market did go to 61.8, which is always what we're looking for next after it gets through that point. 61.8 took you back down to just short of 61.8 the other way. Again, failing to make the new low, a good sign that obviously the market's turning up. This next move up took you right to 38% of this move right here, telling you that the trend is still alive and very positive. Now, the thing here, we're going to go over a few of them that are very clean and some retracements that aren't very clean and how to deal with them. As you can see, this thing went on to new highs, as it should anytime that it holds either 23% or 38%. Now, the next setback in here hit 23% a couple times, struggling to make these new highs and just slightly. But here again, it makes the new high, comes back down to 23% of this move. Now, just so happens it hit a major Gann square as well. But we were looking for new highs for the move, and what you got was a market that stopped at 61.8%. Now, I mean, obviously not making a new high is not a good sign, but what you can be looking for is these levels to watch for, because they're going to give you a good indication of what's possible on the downside at that failure, or give you entry points if you really think this market's going down. This is what you're looking for. And if you really think it's going up, these are the areas you want taken out. So anyway, we had a top in here just the way we did down here in reverse, 61.8, and the market took off. Then we come on 23% and then up to 61.8, just short of another major Gann square. This market then turns around, and after 23%, we're always looking for 38. Now, 38 was the long-term swing point and the most crucial to the trend continuing. Now, here's where it gets a little ugly, and how to deal with this. We had, 4 closes underneath the long-term swing point, but also holding the major Gann square down here before getting back above it. Now, trading outright futures, you could have been easily stopped out in here and thinking it should go to 61.8, which in this case it did not, and it got back up above. So even if you were stopped out, you have to know that by getting back up above this level, that it's still game on for new highs. And this is what's so key to it, that these longer term levels, the bigger they are, the more important they become, you know, in the bigger picture, that you can go through them and come back different times. Whereas little retracements, this can be done all the way down to the minute chart. You're not going to play, you know, for that much you're just not going to make excuses for it. And this isn't excuses. I'm sorry about saying that. This is just the way it is. If it gets back above this, everything, like I said, it's game on to the upside. Now, I just want to show you, you can see it went up through 38%, had a close above it, back below it, close above it, back below it. Again, we always want to see two closes to, validate the level being taken out. We did see it down here, but then that is the swing point. So getting back above it tells you, like we just said, that things can still go higher. Now I want to take you right into the July that's already expired, but it also gives you a cleaner look because this was the nearby at the time of this market. Now they were under the 38% long-term swing point as we just talked about. The rally up to 38% only had one close above it, back below it. But now here's where we get into the 78.6% rule. Two things happened right down in here. One is we hit 38% of this move down. If it really is going to be negative, it should have gone for new lows, and anything that fails to make that new low tells us we should be looking for 61.8 the other way. On the upside here. But what you did have happen here is that when it failed to make that new low, it hit 78.6% of this. And as we've said, 78.6 could either end this whole move down and or it can send you 78.6. But what you saw here was a couple of these, and 78.6 to 78.6 to 78.6, all in this trading range, then to make new highs, and then this is where we get much more clarity. Even though this one here was telling you not only should it go 78, but it could be the end or the start of this bull move by failing to make that new low at a 78.6% level. This rally here, now all of a sudden we're back in gear just as we were back here when it's holding, the 23%, 38%, telling you that the market definitely has a trend. So you can see here that the last one before this nice run up here held 38 perfectly. So you're going to get a lot of opportunities that some are going to be as clean as can be and some are not. Even coming back here to the August, we can see here that when we hit 61.8, and these are different contracts, so you're going to get a little different movement out of them. 61.8 took you to 61.8, which took you back to 61.8, down to 61.8, finally the new high, and then they hold up above the 38.2% before telling you the market's very strong. And here we are up going for the highs, which would fulfill this thing of holding 38%. As you can even see, all those times they were doing 78 back down in here, it still was just right back onto the long-term swing point in the August. So this is why this level being the long-term swing point is so important, even once they've been down through it and back above it. So you can see how well it held, and then we have that secondary reason of 78.6. Yeah, are we going to get into choppy periods at times? Absolutely. Are we going to be as clean as these highs in here that hit these numbers exactly and then just take off? Yes. And are you going to have some times where, you get knocked around a little bit, but you can't lose sight of what happens? I mean, had you gotten short even getting through here, you're out here. Your stop is this point, obviously, swing point. That's what it is. Below it, you can look for 61.8. Back above it, we would be looking for new highs because it is the long-term swing point. Not to be so redundant. But I hope this helps you. If you do trade the grains, please come give us a look at our premium membership. We give these levels through all the grains. It's the Fibonacci retracements is one of the main ones, and the next one is the major Gann squares, all dealing with price. These levels are all given well ahead of time, what to look for, and what to look for when they fail. So until our next video, we wish you good trading.